If you've ever stared at your paycheck and wondered, should I keep this as cash, or is it time to invest in something bigger? You're not alone. The choice between cash, stocks, bonds, and other securities can feel overwhelming. But trust me, it's simpler than it looks. Let's break it down together. First up, the time value of money. Here's the deal: $1 in your hand today is worth more than $1 sitting in your piggy bank a year from now. Why? Because inflation chips away at its buying power. That same dollar could have been put to work growing through investments instead of just sitting there losing value. In short, if money isn't working for you, it's falling behind. So what are your options? Let's compare cash, stocks, bonds, and other securities. Cash is simple. You can use it anytime and it's super safe. But it loses value over time thanks to inflation. Think of the money in your wallet or checking account. Stocks are different. When you buy a stock, you own a piece of a company. There's real potential for high returns, but the price can bounce up and down like a roller coaster. That's the risk. And the reward. Bonds are kind of like you lending your money to a company or government. They pay you back with interest. Bonds are generally safer than stocks, but their returns aren't as exciting. Other securities? Think mutual funds, ETFs, real estate trusts. These give you a mix of risks and returns and often bundle investments for you. For example, a Vanguard index fund lets you invest in the whole market, spreading out your risk. But which is riskier? Here's a quick scale: cash sits at the safe end, but with low returns. Bonds come next, low to moderate risk. Mutual funds and ETFs offer diversified risk, somewhere in the middle. Stocks crank up the risk and reward. Then you've got options, crypto, and private securities, the wild side with high risk and high volatility. Remember, higher risk means you might win big or lose big. So, what's smart for ordinary people? Start early. Let time work its magic. Diversify. Don't bet everything on one thing. Use dollar-cost averaging. Invest small, regular amounts so you catch both market highs and lows. And most important, think long-term. Don't freak out when the market dips. Over time, patient investors usually come out ahead. If you'd put money into an S&P 500 fund in 2010 and held tight until 2023, you'd have seen strong growth even through the rough patches. So here's the takeaway. Cash keeps you safe, but shrinks. Stocks help your money grow, but can be risky. Bonds are steady, but slower. Other securities balance things out. The best move? Start now, stay consistent, and avoid chasing fast money. Thanks for watching. Hit like and subscribe for more simple financial tips that'll help you build a smarter future. And let us know your comments and questions below.